Welcome to this week's ASX strategy session. Thanks for joining me for another show. Great having you with me. Not live this week. I'm filming this around 1 p.m. Sydney time on Thursday due to the Easter break. So we'll get back to our live format next week. But nonetheless, lots of interesting things to talk about in the markets this week with the stocks, with the commodities. So we're going to go through all that in just a moment. Everything today, of course, is general commentary only. It doesn't take your personal situation into account. Having been through all that, let's get into this week's first chart. And we're going to start off with the ASX 200 up here on the screen. And well, from peak fear 2 weeks ago to hopeful anticipation that the worst may be over. But is it time to start getting back into the market? I'll talk more about this in a minute. And then over in the US, should we trust the bounce that we've had over the last couple of days? I'm going to get into that with you in a moment. But before we do that, let's start with this latest price action in the ASX 200. So once again, a quick move from above the moving averages to below the moving averages has resulted in a rebound to the moving averages. We looked at several past examples of this type of price action a couple of weeks ago. The setup for a rebound is essentially when there's a rapid adjustment in investor thinking. And so when there's things are going well, there's a rapid adjustment in thinking due to some sort of surprise. We all know what the surprise has been this time around. And then the thing with these rapid adjustments from above the moving averages, so from above the moving averages to below the moving averages, is they often go too far, at least initially, and then you get a snapback in the opposite direction. So now we've got the snapback. We've got the snapback to the moving averages. What happens next? And this is where assessing the price action becomes so important. Does this rally we've just seen, does it lose momentum and then start to fall back towards last week's lows? Or does it hold on to the gains? Does it hold on to much of these gains and then start to establish a platform for another push higher? It's too early at this stage to suggest one way or the other. All we have at this point is we've got to rally back to declining moving averages. So the moving averages are actually declining now. The 50-day average is below the 100-day average. And when you have that situation, when you've got declining moving averages, when you have price below moving averages, there's elevated risk and vulnerability. I think we need to be patient here. I think we need to be patient and watch how the price action develops over the next few days, maybe over the next week. But there is something very interesting to note about how price has been performing just in this latest period. And I think it's cause for some optimism. I'm going to cover the US market in a moment. I'll cover that in detail in just a moment. But last Friday, so if you remember last Friday in the US market fell heavily. It then fell again on Monday. But what I want to look at here, I want to look at the ASX 200 and what it did on those days. So this bar here, which you can see the cursor on, that is last Friday. And this includes the overnight session as well. So it's picking up that price action from Friday in the US where prices fell heavily. And then Monday, here's Monday for the ASX 200. So again, prices were falling on Monday in the US. But then that, of course, picks up Friday's price action as well. And look what the ASX 200 did. The market was essentially steady. And so while the US market made new lows, the local market didn't even get close to retesting the previous week's low. So we have an instance of decoupling from the US. Not something we often see in the local market. The local market often tracks the US quite closely. It also suggests that I think peak fear may have passed a couple of weeks ago. That doesn't mean the ultimate low is in, but peak fear that was being driven by that panic style selling we saw. It appears that may have dried up. So whether a lasting low is in place yet is yet to be seen. But I think what we've seen this week, I think it's a tentative positive that prices were able to hold ground when the US market was making new lows. One of the possibilities we discussed recently was that a big trading range forms. Maybe prices, and like you can see, prices have been range bound very much since October last year. And so maybe we get a situation where prices continue to move either side of the moving averages for some time yet. I think that's still a real possibility. Quickly looking at some of the key sectors, starting with the materials. So this is the ASX 200 materials index, and again you can see that bungee style effect where prices are stretched above the moving averages, they rapidly come down, they get stretched below the moving averages, and then you have the rebound. We see this time and time again in markets. It doesn't happen every day, every week, but it's not an uncommon type of pattern. And the move back above the moving averages just on the last couple of days, so Wednesday and Thursday, that move back above the moving averages, it disengages the downward momentum that was in place during, of course, the rapid sell-off. So it disengages that downward momentum. But I think that the strongest phase of this snapback rebound is now probably over. I think a likely scenario is that prices now form a big range between the March high and the recent low. Materials remain an overall upward trend. If we just compress this a bit, you can see from last year's low. There's the low from April last year up to the recent high. That was an 83% rally, and so that upward trend, I think that overall upward trend remains in place. But I think it's now going to take time. I think it's going to take time to consolidate that large rally and time to repair the technical damage done by this recent sell-off. But I think the positive here is that as it stands, the overall structure here remains positive, and I think that is a supportive factor for the ASX 200. And then, of course, we have the financials index, ASX 200 financials, and this key group of stocks continues to hold up quite well. Prices are largely range bound. They've been range bound really since prices hit all-time highs back in October, and it's really been largely range bound trading since then. Trading either side of the moving averages, you can see prices have crisscrossed the moving averages several times. I think the fact that the financials continue to be holding above previous lows, we've got these lows from January and then December, so prices have been holding above those lows at least so far. I think that's positive, and it's also positive. I think that this index has been fairly resilient. And just lastly, coming over to the equal weights, this is the ASX 200 equal weight. It's interesting to see the strong rebound. This week. Last week, you'll probably remember we spoke about how stretched prices were below the 50-day moving average. So this being the red one, the 50-day moving average. I just quickly put on the indicator that we used last week to demonstrate that. So I'll just compress this, get a little bit more price action. Let me just put a marker on here. And the point we were talking about last week was once the equal weight, and we can do this for the ASX 200 or the small ordinaries, emerging companies, can do it for them with those as well. But once we get to this region around about 8% below the 50-day moving average, there's tendency for the equal weight to be stretched to a point where it does snap back. It's happened. Happened several times on this chart. Not pinpointed, of course, but generally. And look, once again, that's been the reaction which has happened this time. We've got that snapback from oversold positions. So I think it goes to show that it's worth being aware of when a market is nearing an extreme. Now, extremes can always get more extreme, but I'm often hesitant to get super pessimistic or, for that matter, super optimistic when we see there's a reasonably rare reading from how extreme or how stretched a market is from its moving averages. The rebound that we've had I'll just get rid of that now. This rebound, I think it does, well, the rebound relieves some of the pressure of the recent selling, but I don't think it necessarily signals a bottom. At the moment, this is only just it's a rally. It's a rally below declining moving averages. Can't escape the fact these averages have crossed and they're still pointing to the downside. So I still think this is a situation that requires caution. Let's watch how the price action develops over the next week. Can prices hold on to most of these recent gains, or do they slide back towards last week's low? And this will indicate if the dip is being bought or if the rally is being sold. As I said last week, I think it's a time for continuing to follow a good plan and to act systematically, not emotionally. I'm continuing to hold stocks that haven't given me a reason to sell. I only want to sell because my rules tell me it's time to sell. So avoided selling in panic, and holding stocks where I can continue holding them, where there's a good reason to continue doing so. Okay, so we're going to move on to the US market next. But of course, if you're getting some value from this, please click that like button. It makes a big difference to me because YouTube shows other people the work I do, and that helps me heaps. So please click that like button. Tell me what you think. Is this a short-term reprieve or a start of a longer-term recovery? What do you think is going to happen in this market? Always interesting to know. Okay, over to the S&P 500. So should we trust this bounce? The S&P 500 has put together 2 up days in a row. There's been, and that's an uncommon pairing to get 2 up days in a row. At least in recent weeks, it's an uncommon pairing. But is that enough to signal a turnaround? So let's go through what we have. Last week, I spoke about the increasing vulnerability and the presence of a cascading structure. So cascading structure, that is where you get where the declines get progressively more aggressive. You can see the declines starting to get more aggressive, and the rebounds remain weak. You get these muted little rebounds, and then you get the more aggressive selling. And when you get that, the risk of a sharp decline significantly increases. And that's what we started to see, the selling pressure. So this is where we were speaking last week on Thursday afternoon. Oh no, it was Friday afternoon in Sydney. Then we got the Friday session in the US, and we started to get that cascading sell-off. Increasing selling pressure that continued into Monday with further selling, and this is when the risk from a cascading pattern is greatest. This is when the bottom can really fall out and prices completely accelerate to the downside. But fortunately, that didn't happen. The worst didn't happen. Tuesday's rally has acted as a bit of a circuit breaker. And it's disengaged that building downside momentum, and we've got some additional buying which has come through on Wednesday. But is that enough to turn this around? Like I said with the ASX 200, I think it's too early to judge. And even more so in the US, we've only got these 2 up days. And if you look at Wednesday's price action wasn't particularly impressive. Opened, started to move towards the highs, but then closed in the lower half of the range. So not an overly strong day. While the reprieve from the selling is helpful, and I think that lets us refocus on our plan, it removes some of the panic from the situation that was clearly starting to develop late last week, early this week. It doesn't change the vulnerability from the structure. The key features to note, we've still got these declining moving averages. Moving averages have crossed to the downside, and we've still got a series of lower lows and lower highs. I think it's going to take more than a 2-day rally to neutralize that setup. I know a lot of people want to come in, they want to try and buy the low. They want to say, look, far enough, this has come far enough, time to buy. But I think the risk is that you end up buying a rally which others may be getting ready to sell. And there just isn't enough here to indicate, for me at least, it's not enough here to indicate that the low is in. Same applies when you come over to the NASDAQ. So this is the NASDAQ now. Yes, there's been a strong rally off the low, but the NASDAQ is still below resistance from this cluster of lows we've spoken about. That was the bottom of a previous trading range. So it's sitting below that cluster of previous lows. And it's also below, again, declining moving averages. I think the strength of the recent rally, I think it disengages the immediate downside momentum, but we're now dealing with a structurally weak chart with prices below these negative moving averages. And the big seven, so the big seven, Microsoft, and Nvidia, Apple and the like, Meta, they form the Magnificent Seven. This is the Magnificent Seven ETF. And this group generally continues to struggle. And I think for the S&P 500 to mount a serious rally, it needs leadership. And this has been the source of market leadership for a long while now. Big tech has led the way, but it's at the moment it's been leading the way into the downside. That's not to say this group can't recover, but there aren't clear signs. There are no clear signs that a lasting recovery is underway just yet. Yes, there's been a rebound, but really this could just be short covering. A lot of selling has gone on in recent weeks, and this is what happens in sell-offs. You get these larger rallies, and remember, when you do get like a selling phase in the market, remember that the sell-offs often include sharp counter trend rallies. And this is what can make these sell-offs so tricky to trade, and why they're often harder than your typical uptrend, which rallies and has a fairly controlled pullback, rallies again. These sell-offs, they can have these sharp rallies, makes it extra difficult. The quick rallies, they draw people in on the hope of a recovery, only to then turn and head lower again. This may not turn and head lower, but that's why I think it's patience in watching how the price action develops, rather than assuming every uptick is the start of something bigger to the upside. That's why I think we need to let this price action develop. As I've been saying a lot lately, be prepared for volatility, follow your plan. I don't want to be scared out of the market. That said, I don't want to then just shut my eyes and hope for the best either. For me, it's been that sliding scale I've been telling you about, the sliding scale of reducing risk as stops are hit, rather than simply panic liquidation across my whole portfolio. It certainly hasn't been that. It's been sliding from fully invested to less invested. It's a sliding scale. So this current period, well, it's going to pass. They all pass. All these unpleasant pullbacks, corrections, even bear markets, they all ultimately pass. My aim is to keep as much capital intact as I can, and then be ready for the new opportunities when they invariably appear. But again, I stress it's patience, not rashly running in and wanting to buy every update. Okay, so I'm going to move over to the small caps next. I've got the the US small caps, Aussie small caps. We go through the commodities, but of course that wraps up the free section. If you're not a strategy session member, there's a link below. You can click that, come in, get the rest of the session, and then be with us next week when we go through member stocks and look at all the price action. You can ask about stocks yourself. So there's a link below. Click that and become part of the strategy sessions going forward. Okay, so let's now go over to the Russell. We'll start with the US small caps.